one of the startups that they incubated was FinLocker. And at the time when they started it, it was built as a tool for a lender to use in the middle of the mortgage manufacturing process. And almost from day one, when I saw the first iteration, my mind went right to there's something bigger here. And that something bigger is really what we've been doing now for the last several years, which is empowering consumers through this financial fitness journey that is anchored on their goals and objectives for home ownership.
There were times where I thought maybe it was a little bit of a stretch when I bought my first home, and then you get into a second home and you up that and you go, wow, that was a stretch. But I want to break down two things. If you're emotionally and financially ready, I agree with you. You're going to be in a good position because real estate is generally just going to go up based on the historical averages.
Unfinished Business Podcast Show with your host, David Sliman.
Welcome back to Unfinished Business, everybody. Today, we are going to be talking about financial empowerment. We're going to be talking about homeownership and the evolving role of technology in personal finances. And listen, there's nobody better to break this all down than our guest today, Brian Vieaux. Brian's a specialist, a veteran really in the mortgage industry, but more than that, he is dedicating his career to helping people achieve financial well-being and home ownership, which is important as well. It's a big topic today. And he's the president of FinLocker, that's his company. And more than just being, again, in the mortgage industry, we're going to talk about financial literacy today. He's a strong advocate for financial education, does a lot of speaking around this. He has his own podcast around this, and he really does shape his career on helping people and individuals and families build credit, prepare for major decisions such as buying a home. And we're going to dig into all of that today. So without further ado, Brian, I want to welcome you to the show. Glad to have you here today.
Yeah, man, thanks. It's quite the intro there. I hope I can live up to that.
Well, you got, listen, I've been following your stuff and I you know your stuff, and that's why I have you on this show, because we're going to really dig into it. But before we get into the industry today, you obviously have had an impressive career. What's inspired you to kind of make the shift more than just being, hey, a mortgage broker or in the mortgage industry? You've really made this shift to financial well-being, even through home ownership, which is a big part of it. But talk to us about that shift.
Yeah, so 5.5 years ago, I left what I now affectionately refer to as the comfy confines of corporate. I worked for a bank at the time and joined FinLocker, who was a startup technology fintech at the time. Rewind the clock a little bit. The founders, I've known the founders of FinLocker for about 2 decades. We did a lot of business together in the mortgage industry. They successfully exited a business, and one of the startups that they incubated was FinLocker. And at the time when they started it, it was built as a tool for a lender to use in the middle of the mortgage manufacturing process. And almost from day one, when I saw the first iteration, my mind went right to there's something bigger here. And that something bigger is really what we've been doing now for the last several years, which is empowering consumers through this financial fitness journey that is anchored on their goals and objectives for home ownership. And there's a lot there, but long story short, after 30 plus years in primary mortgage origination space, where I led sales teams and was responsible for growth at companies, I started to get the itch to do something, to place a bet, let's just say. And the bet, the bet was somewhat on myself, but more on this technology and this idea. And today, what FinLocker is focused on is we've built this technology that's consumer facing, but our technology is delivered to consumers through a mortgage originator or a mortgage company. So we I'm still very connected in the space, but we're essentially solving pain points for two entities: a consumer, and then in between the consumer and our technology is typically a mortgage loan officer.
So it basically, the software helps, like you said, both sides of that. But from a consumer standpoint, how has it helped them manage their financial lives, or is it almost do an audit, so to speak?
Yeah, to some degree. So
Yeah.
one of the ways I describe our solution is, if NerdWallet and Mint.com and Credit Karma and Credit Sesame and even Zillow all came together,
Uh-huh.
then that's really what FinLocker is. So we've built
Wow.
we've engineered this experience that includes a half dozen consumer financial tools, from budgeting to financial goal setting and tracking and monitoring to credit education, credit improvement, credit monitoring, all the way to searching for a home inside of our technology, and combining the financial readiness of the consumer with where the properties that they're most interested in line up, how they fit in a budget. And so, um, you know, for the mortgage companies that we serve, the product's really interesting because we give them a very modern consumer experience that otherwise only the biggest logos and brands in the industry would have access to. So we've somewhat
Yeah.
democratized the access to this technology for lenders. And most important in this whole equation, and I talk about this a lot in my LinkedIn posts, is I truly
Sure.
believe that I believe that the local loan officer, and I say local, both physical and digital, right? Because we're everywhere now. You and I are talking on this podcast. I'm in Detroit, Michigan. I'm not even sure where you are, David, but
Yeah,
we're
I'm in
probably not
Park
local.
City, Utah.
Yeah, there you go.
Yeah.
So there's this aspect of local, but it's really a hyper digital local experience, really. But we we believe that the local loan officer is the single best source of financial literacy, education, and preparation for home buyers, especially first-time home buyers.
Yeah. Yeah. So listen, we're going to start with that because I want to dig into the first time home buyer because listen, it can be really intimidating for home
Yes.
ownership. What are some of the biggest barriers people face when they're trying to buy a home for the first time? I'll let you take it from there.
Yeah. I mean, I think credit is always a challenge. Not in the sense that someone's credit may be bad per se, but a lot of people, especially younger people, younger in their financial life, haven't really had a chance to build up enough of a credit profile that maybe is going to help them when it's time to apply. So one of the things that we are really passionate about is, and we coach this all the time with our clients, our loan officer clients that work with us, is it's never too early to get involved in someone's financial life. And I say that, and
Yeah.
I'll paint this picture. Let's say, as a loan officer, I'm introduced to somebody at a community event or wherever, and they're 22, 23 years old. And maybe they're not even thinking about buying a home for the next 5 years. But I tell loan officers those are the perfect people to start to engage with in this spin locker technology, because they're the ones that need the tools the most. They need to understand decisions they're going to make over the next 3 to 5 years and how those decisions are going to impact their credit, which then ultimately impacts their potential ability to buy and own a home or multiple homes, right? So for us, it's not always about credit improvement per se, as much as it's about credit optimization and really understanding
Yes.
how decisions you make early in your life can have a lasting, impact down the road, or lasting consequences. So I think credit's a big tool that we see heavily used across our technology. Um, The other
And
interesting
how does
thing,
your and one thing, Brian? I want to before you go into the next thing, because I want to talk about the other interesting thing. But how does your software help manage their? Will it track it for them and grade them out? Like, I'm trying to get a visual of this
yeah.
software because it's really interesting.
So so at a high level, we use stars, and there's
Okay,
maximum
great.
maximum of 4 stars. So our software is going to perpetually assess a user's readiness across 4 dimensions. Number one is assets. Do you have
Okay,
enough? Have you saved enough for the combination of your down payment, closing costs, and a healthy reserve account, right? Because it's not just about what does it take to qualify. We're very much about sustainable, successful, long-term home ownership. And
yeah,
so, if you're in the planning stages as a home buyer, you should be thinking about not just the down payment, which you can buy a home with as little as 3% down these days. A lot of people don't know that. Um,
oh, did not know that.
but you should always also be thinking about there's going to be costs associated with the closing of the transaction. And then, you know, once you own a home, stuff happens and you need to plan for stuff happening, whether it's your water heater going out or an air conditioner or the roof leaks, all the stuff that no one teaches us in early in life that becomes part of the total cost of home ownership. So that that asset, how much you've saved and or planning on saving is a big piece of the preparation process. And this is why, again, I say the earlier a consumer can start thinking and planning, and the earlier a mortgage professional can start helping somebody along that line, um, the better the result's going to be. Because it's certainly easier to have a 5-year horizon, to save $60,000 versus trying to do that in 2 years. Um,
Yeah, yeah, that's a great point. Great
so,
point. You really
so
you're planning this out. I love it. Yes, great.
yeah. So dimension one is as assets. Do I have enough? What do I
Yeah.
need to save, and do I have enough now, or how far am I away from achieving that metric? Credit. So we do assess the consumer's credit. We prompt a user to connect their credit in the app, and then the consumer's going to get an update every 7 days on their credit score, and every 30 days we refresh the underlying credit report. And
Okay.
one of the coolest features we provide in the app for a user is the ability to model actions I might take as a consumer and how those actions would convert into a change in my credit score. And I'll explain one in particular. Let's just say
Okay.
as a consumer, let's say I had 3 credit cards and a balance, an aggregate balance on those cards of $18,000. Uh, if and let's say I got paid a quarterly bonus of $6,000, and I didn't need that for anything other than to manage my finances. And so one of the actions someone could model is, what if I paid down my balances by $6,000? What would that do to my credit score? And it might move it significantly where someone's like, that's a good thing to do, or maybe not. And so those are actions somebody can model. The inverse is also true, and we see this in our app. You know, there's a lot of things in the news about different jobs being eliminated, and just a lot of
Yes.
friction happening in the economy. And so as a consumer in our app, if you were facing a job loss or a reduction in pay, one of the actions somebody could model is, if they had to let a credit card or two go delinquent, and let's just say 60 days delinquent, what would that, they could model the impact that would have on their credit score. And
Wow.
of
So you're
course,
almost like forecasting. You're like
yeah,
forecasting your credit.
that's
What
it.
an interesting concept. Wow.
And a lot of people just don't, as prevalent and available as credit data is out there for consumers, it's still shocking to me
Yeah.
how few people actually actively monitor their credit. The other two things, real quick, that the app is assessing
Yeah, please.
is what we call income and employment. So is your job and your job history and the income you derive from that job suitable for the goals and objectives you have for buying a home? Meaning, do you have enough income and do you have steady employment, at least a 2-year history of employment because that's a something that a lender is going to look at when they qualify you. And then the last thing we do, which is really unique to a tool like ours, is we calculate this ratio called debt to income ratio. And
Yeah.
in mortgage lending, typically the sweet spot is anything under 40%. So if your gross income, if your monthly debt payments are less than 40% of your gross income, then that typically means you're, from that perspective, you're qualifiable for a home loan. And so those are the four dimensions that we perpetually assess for a consumer. And then we just give them this like their own little sandbox to play with these different widgets and models to see what, optimize what their best goal and objective would be for, the price range of buying a home and the monthly payment, things like that.
Yeah, listen, you've said so many great things here, and I think those 4 points that you just brought across are probably the most important to securely buy a home, right? Because like you said, you can come up with a great down payment, but if things are going to happen, you just plan on it. I mean, it's funny you said the water heater thing, because my water heater went out this weekend. It didn't even go out, but it's I have to have it replaced based on what was going on. But it's so true. It just one day that's the sort of stuff that happens. So those points right there, play them back if you're listening to this for the first time. Go back and listen to those, because essentially, not only is his software going to manage it for you, but even if you don't use the software, those are just great, impactful points to really put yourself in a more stable position if you're looking to buy a home, because it's a big commitment. It is absolutely a commitment, but a lot of people do it, and I do believe it's for everybody. So let's talk. You touched on the economy a little bit, okay? With rising costs, financial uncertainty, what advice do you have for people right now who are looking to buy a home? Because let's be honest, interest rates are up. They've moved a little bit, but nothing nominal. And what kind of advice are you giving people out there at this time?
So I'm a 35-year now, career mortgage professional, right? So my advice is always going to be leaning towards it's better to buy than rent. And, there's all kinds of different studies. I've seen the National Association of Realtors recently reported that the personal net worth of a homeowner is like 40% higher, or 40 times higher, I should say, than that of a renter. Okay. And so why is that? What's the impact there? Well, for the last decade plus, we've had consistent year over year growth and appreciation in real estate. Some markets, like Park City as an example, probably appreciate at a rate that higher than other markets like Detroit, in contrast. But even in Detroit, over the last decade, the annual appreciation is averaged right around 5 to 6%. It's a significant, over 10 years, that's a significant growth in property value. And so for someone that's not a homeowner today, and you're thinking, when's the right time? I always subscribe to, now the present time is the best time if all other things line up so that you're financially and emotionally prepared, right? And the reason is interest rates, while higher today than they have been in recent memory, are still relatively low on a historical basis. I got in the business in 1991, and the average interest rate was like 11.5%. Today, it's in the 7 handle area. The other thing to keep in mind as a prospective home buyer is it's relatively simple to refinance your mortgage rate. Meaning, if today you buy a house and you got a 7.5% 30-year fixed interest rate, and 18 months from now, rates are in the 6s, it's a pretty straightforward process to take advantage of lowering your rate, which will then lower your payment. What you can never do is make up for the 18 months of appreciation in the real estate you don't own. So,
Great point.
This is where I just say if everything lines up and you're emotionally and financially prepared, now is the best time to buy.
That right there, 2 words: emotionally and financially prepared. Don't wait. I'm a big believer in this because I've lived this. There were times where I thought maybe it was a little bit of a stretch when I bought my first home, and then you get into a second home and you up that and you go, wow, that was a stretch. But I want to break down 2 things. If you're emotionally and financially ready, I agree with you. You're going to be in a good position because real estate is generally just going to go up based on the historical averages. Now, listen, we don't have a crystal ball here. I'm not saying that, but historically, based on everything that's gone on, I really am a big believer in that. And then we talked, you started this off with, listen, if you're paying rent right now and you're paying $2,000 a month for rent, I mean, that is essentially going to somebody else.
Yes.
Okay. If you're going to buy a home and you're going to pay, let's just say, you can afford the $2,500 for a mortgage, that equity is staying with you. Like that money is staying in with you and it's not going out to somebody else. And I think that's such a big point. Well, I can afford it. I can turn the key and I can walk away. But you're not building up any equity. And if you're waiting for the mortgage rates to go down, you're right. You can refinance. If you've done it at that point, when you refinance, you're going to have a much better, easier position to do it.
No question. And in a lot of markets, I'm pretty sure Park City probably falls into this, certainly parts of Detroit, because today's rate is in the 7 handle, there's a lot of homeowners who may have otherwise, sold their homes and either moved to a new town or moved into smaller homes, but they're kind of locked into some degree because of the rate that they already have. And so inventory has created a challenge on the buy side, but it's also a driver for continued appreciation. There's just not as much on the market at any given time, and which I think again, if you have the combination of emotional and financial readiness, now is the best time.
Absolutely, you're gonna make it back. What we talked about refinancing. How much of a percentage point would you recommend someone to consider refinancing? So let's shift the gears here. You got somebody who's bought a home maybe in the last couple of years. Rates have, I would say in the last 2 years, rates have started going up to that 5-6%, maybe a little after. At what percentage savings do you recommend to pull that trigger?
So I think every situation is unique to a degree. And so generally speaking, the way I looked at it when I was originating loans and even as a consumer myself is if the cost to refinance, let's just say it's $2,400, just to keep the numbers round.
Okay.
If it costs me $2,400 for this transaction, closing costs, appraisal, blah, 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 typically what I would think you would want to recoup that cost, inside of 2 years, 24 months. And so in that case, it's $200 would be your target savings on a payment. Now, that's like one rule of thumb. The other thing is if you have other personal financial debt, high interest rate credit cards as an example, maybe doing a refinance where you actually pull some equity out and pay down higher interest rate loans that you have, typically personal loans, credit cards, maybe having the exact same payment that you have otherwise, but not having, $300, $400 in credit card payments might be the answer.
Right.
So, it used to be if it was a 0.5% drop in rate, that was like the trigger where you would quote unquote be in the money for a refinance. I still think that's a good indicator of if you're starting to see the prevailing market interest rate at or below a 0.5 point of what your current rate is, you should probably talk to a mortgage professional. It doesn't mean it's going to be the right time, but talk to
Sure.
a mortgage professional at that point.
Yeah. Yeah. I think that's a really good point. So, based on today's economy, right? What do you think is more challenging in the mortgage business, or for people who are looking at buying a home, or is it the rates right now, or is it more the education around this conversation we're having today? Because based on what we're talking about today, there's so much already I've picked up, and I'm sure people listening at this point, but more of that financial literacy, I think, is more important than just watching the rates. But
I
what do you think?
Yeah, I'm always like, I've said it a couple times. If you're emotionally and financially prepared, now is the time. And now could be today in this conversation. Now was 12 months ago. Now is 12 months from now. And so, to your point, I do think the biggest challenge is the knowledge and expertise and understanding of all the moving parts that go into not just qualifying for the loan, but understanding how home ownership fits into, your own personal financial goals and objectives. You know, if you're somebody that enjoys a lot of travel and independence and can work remote, and so you're spending 2-3 months, a year on the road, maybe owning a home isn't the best thing for you, right? Versus
Yeah, yeah.
if you're more about getting settled down. So I think the financial education piece, and this is why I've been so passionate about financial literacy when I came over to FinLocker, is that there is a massive gap. I mean, we still don't really teach in our school systems, personal finance. Like, I mean, I grew up in a world where I had a 6-month class on personal finance, home economics, right? You had all these different
Yes.
different things. Those are gone for the most part for younger people, and then we send a lot of people out to college or into their working lives without a foundation of basics. Like, I mean, could a young person today even contemplate balancing a checkbook? I mean, there is
Right.
no such thing, right? There's no such thing as a checkbook. So I think the financial education piece, I think it's such a massive need. Um, and one of the realities is that most younger people haven't accumulated enough assets in their life to have a financial planner or a personal banker for sure. And so this is why I think that local loan officer can play such a vital role in financial education, financial preparation around homeownership in their communities, because there's really not a better resource for that.
Yeah, and I really feel like you're this advocate for it, right? Because I mean, do you think the industry's adapting well to help people achieve, home ownership despite the high costs? I mean, that's the
Um,
biggest thing. How can the industry adapt better to this? Because that's what I'm hearing from you.
yeah, I would say we have work to do for sure. We can improve as an industry, and we really should, and we owe it to future homeowners to be better. Now, there's companies like FinLocker, and we've built technology
Yeah.
that we believe sets up the modern, next generation mortgage originator for success, leading with education. There's a nonprofit that is new to the space called First Home IQ. First Home IQ is all about financial education, financial literacy. And so while we're building technology, they've built curriculums and content that loan officers can subscribe to, and then use that education content and curriculums to go into their communities, get into the high schools at the senior class, and do personal finance seminars and education, and go into community groups, church groups, and present this financial education. And so there's some interesting areas that are bubbling up within the housing finance industry to support this. probably the one thing that I'm most encouraged by is that by and large, I see loan officers. So the loan officer is the person who typically is going to take a loan application from a borrower, a home buyer, and basically take them through the entire process to get approved and ultimately secure their financing. And I'm seeing more loan officers show up both physically and digitally in their communities and leading with education, which is really encouraging.
That's great. It's great because I love this post you had, right? You say, stop. If you're a loan officer, stop competing at the point of sale. And I want you to expand on that. It really is resonating with what you're saying, but I love this post. I listened to it recently, and I want you to explain that from the loan officer standpoint. And it does affect the consumer as well. And I think this is important.
Yeah, thanks for that. And by the way, I think this concept resonates just about in any sales profession, but
Yes.
in the home buying and financing profession, traditionally a loan officer, and for your audience, most loan officers are 100% commissioned salespeople, right? And this will be graphic,
Yes.
but basically they eat what they kill, right?
Yeah.
And traditionally, most of a loan officer's business came by way of a referral from a real estate agent, a realtor in their community that they partner with, right? And so call that the point of sale. The point of sale in my post that I was referencing is when the first time a loan officer is engaging with a home buyer is when they come into their digital or physical storefront, contracted hand. They've already, wrote the contract to buy the home. Now they're going to get a loan. So let me say that again. And this is crazy. This is crazy how this has worked for decades. But the home buyer traditionally doesn't meet the loan officer until they've already signed a contract to buy a home. And the purchase of that home is dependent typically on at least 80%, maybe more of the home purchase being financed by a mortgage, by a loan. And so that's the point of sale, right? And so if you're my home buyer and I'm your loan officer and you're meeting me for the first time, you're probably going to assess me on a couple things. The interest rate I can offer you, and maybe my fees and costs. So very, very much your assessment of me is probably going to be based on the economics of that transaction. And
it's all
I'm not
transactional.
Exactly. Yeah. And I'm not saying this to discount the importance of rate and fees. That's all part of the equation. But if instead you and I met 18 months ago because you showed up at a first-time home buying seminar at our community center, and you were there to learn because you had a plan in the next 2 years to buy your first home, and so for every 3 months you came to my webinar or seminar and were learning from me about the tricks and tips and do's and don'ts of home buying and financing and what not to do when it came time to get the loan for the home that you're now buying. You and I have already built a relationship. There's trust established through that relationship because I've given you 18 months of my time, my resources, my expertise and experience to help teach you and prepare you for this point in time where you're going to buy a home. Again, not saying at that point rates and fees are not important, but they're a lot less important because you've seen the value that I've provided in terms of education. And so that's the point of thought, is that 18-month up funnel beginning of a relationship with a consumer versus having to compete at the point of sale, which is going to be very much an economic decision.
Yeah, so, right. An emotional one too, because you're all in emotionally because you love the house and it's like, well, okay, what's another percentage point or it's a lot actually. Yeah. So, if I could have saved up more money for a down payment, maybe I could have had a lesser, like that whole education thing, I think is such a great perspective.
Well, even early in this conversation, I think I threw out that you can buy a home with as little as 3% down, right? And you were like, I wasn't aware of that.
Actually, I wasn't aware, yeah.
if you're a veteran and you're buying a home as a veteran, a veteran has a benefit from their service, which is access to this VA loan, a Veterans Affairs loan, a mortgage that's backed by the U.S. government. And a veteran can purchase a home using a VA loan with zero down payment. Now,
Wow.
I don't suggest that that's the best route, but
Right,
if you're working with a local loan officer that understands programs and can show you the benefit of, let's just say I'm not a veteran, I'm buying a home and I have 20% saved for a down payment, but it's sitting in some kind of investment vehicle yielding whatever 7.5 or 8%, whatever that yield is.
Yeah.
It might be that I'm better off only putting 5% down, having a loan with personal mortgage insurance, and keeping this investment intact over here. Those are all things that you would learn and gain knowledge on to make the most sound financial decision for your personal life or your family life if you're buying a home for a family.
So listen, outside your platform sounds like it automatically does a lot of this stuff, which is so great, right? It's almost and to educate, and you got to look at it from both sides. You got to have education from the mortgage broker, and you've also got to have the education on the consumer side, and really be able to use it as an effective tool. Outside of that, what are some books you would recommend for people, anybody who's who has a home or is thinking about buying a home, or any things that you would recommend there as a good read?
Oh, wow. Good. Well, this is not really for consumers, but it happens to be sitting right at my desk. I co-authored this book called Rethink Everything You Know About Being a Next Generation Loan Officer. And we put the book together to help loan officers who want to serve the next generation home buyer in the best way possible. And that's really through education and preparation. Great question on the books. You kind of stumped me there from a personal finance perspective. I would say, there's all kinds of different strategies around budgeting, right? You've got the Dave Ramsey School of Budgeting that really is negative towards taking on debt, right? I think they've kind of come to the side of the world where real estate debt can be considered good debt. Used to not be the case, but I think if the appreciation is greater than the interest rate, then it's probably good debt. I would say this: I don't know that there's a single book or author I would recommend. I would suggest that that people understand, understand your own goals and objectives, and if those include home ownership, as a young home buyer, do you really need to be in the best school district if you don't have children? And so, to me, there's when we bought our first home, it was definitely not in the best geography in terms of where you might raise children and put them into school. But we bought that home knowing this was this was stage one of a series of moves we were likely to make until we got to our dream home. And so I don't have a great answer for you on the book side, but
that's good. No, that answers the question. Obviously, I think a consumer could probably get a lot out of what's in your book. Just one that sparked recently for me, which is a great read, is called The Psychology of Money.
Yes.
And it was written right after the 2020, I think it was written in 2022 maybe, and it's not what you think. It's not like, hey, you need to be, putting X amount of dollars away to make X amount of debt. But it really talks about the evolution of money as a whole, where it started, when it started, the percentages of increase you were talking about on the housing market, the financial institutions, Wall Street itself, how money grows, how you can get it to compound without having to sock away $100,000 a year. I mean, it's a really good read. and some great examples of historic numbers and how credit evolved. It's just a really good read. So I think that for any listeners out there, maybe pick that one up as well. But listen, this has been a fantastic conversation around the mentorship of really doing one of the most probably can be one of the most important things. I know in my life, home buying has been very advantageous at times where I was a little bit uncertain about doing it. And so I think it's important. But you mentioned something here a second ago, the idea of maybe paying a little bit more to be in a higher end neighborhood or a better school district if you don't have children. How do you factor that all in? Like, because it does pay off. I will say that I lived that, where we moved into a neighborhood that was had a great school district, and it paid off. When we did sell the home. But what are those factors you take in outside of just money? What are some of the factors you take in when buying a home?
So I think, unless you're buying your first home that's going to be your forever home, which doesn't happen it's very rare.
Thank
right?
you. Thank
very
you.
Rare.
Yes.
I always view home, and so my two sons both are first time homeowners, and they've one of them's owned for 3 years, the other 2 years. There's no question in my mind that they will not be in those homes. They will not be living in those homes in the next 5 years. Now, they both may still own those homes as rentals. They may have converted them into rentals, right? And then they're onto the next stage. So I kind of think of it this way. Resale of a home is definitely something you should be thinking about. Like, if I buy today and I sell in 5 years, is this a market? Is this a community that realistically is going to appreciate, at least at the median level of this area, right? And so there's research that you do there. That's why you also not the loan officer is not the only important professional. If you get a local real estate professional that understands trends in the market, that's another great resource for you.
Great advice right there. Great advice. A great real estate agent, because it's a team you're building.
Yes. It's your financial team, really, if you think about it. I mean, for most first-time home buyers, that home is going to be the largest asset on their personal portfolio. And then the mortgage is going to be the corresponding largest liability, right? So
great point.
They are your financial team. Another thing is, this is something I wish I would have really understood when I was buying my first home almost 30 years ago. Like if I was doing it today, I would buy a 4-unit home, live in one, rent the other 3 units out. More than likely, the net rent on those other 3 units are going to cover the entire mortgage
cost
and the whole thing, right? So there's a friend of mine. He teaches this 4-3-2-1. Your first home is a 4-plex. You live in it for a year or 2 years. Your second home is a triplex, and you live in that for 2 or 3 years. Then a duplex, and then finally, call it 10 years down the road, you're in your single family home, and you still own these other 3 properties that collectively have 8 units that are all generating cash flow for you.
What a great concept. What a great concept. I wish I'd have done that. That's a great concept to go by in building some financial success, because you're right. Then you're going to get it paid for by the people who are living in there. And 2, the appreciation is going to be, you're going to make the income on the appreciation. So sure. It's great advice. Great way to sum that up. All right, listen, we've got FinLocker, you've got something that's growing, you've got AI, you've got all this stuff. what are some of the new exciting developments or projects you have on the horizon for yourself before we let you go here?
Yeah. So I'm actually working on another book, and it's really a book about my journey and experience on the LinkedIn platform. Um,
Okay.
and, and so, and how a platform like LinkedIn, can be really instrumental in your success in business and in sales in particular. So that's one thing. I'm kind of doing that on the side. The other thing is we're knee deep into continuing to evolve the tools in our tech, in our product, and starting we're early in the AI game in our technology, but starting to introduce some ML, machine learning, and artificial intelligence to help consumers, users of our app, run even more, what if scenarios for themselves. So
Yeah.
excited to see where that all goes.
That's fantastic. Well, Brian, listen, I want to thank you for being on the show today. I think, listen, it was educational for me, and I know it was going to be educational for our listeners today. You've brought some great conceptual ideas and actually experiences to the table here. And I really want to thank you for being on the show. So it's been great. It's been great.
Thank you. I appreciate the opportunity. Thank you.
Absolutely. All right, everybody. Wealth, health, success to all of you out there. Go get a win today. I don't care how big, how small it is. Go get a win. And listening to the show, you just got one win. So, Brian, thanks again for being on the show. Where can people find you, Brian, if they want to reach out to you?
LinkedIn's a great place. So go follow me on LinkedIn and or go to finlocker.com and you'll get caught up with us.
Check it out, everybody. This guy knows his stuff. He's a great resource. And Brian, again, thanks for being on the show. It's what is making it great. Thanks to all of you. Like this show, share the show. Just share it with one person. We appreciate it. And we will see you all next time. Thanks again.
Unfinished Business Podcast Show with your host, David Sliman.